My name's Ethan Braid. Today we're going to talk about the 4% retirement spending rule. We're going to look at what happens if you use bonds as your primary investment strategy. We're going to use actual results over the last 25 years for $1 million investment in the Vanguard Total Bond Market Index Fund for our analysis. Let's quickly talk about what the Vanguard Total Bond Market Index Fund is. This is an intermediate core bond fund. It has a very low expense ratio at 0.15%. The fund has 26% in corporates, almost 50% in governments, under 1% municipals, over 22% securitized, and the rest in cash. The fund has a trailing 12-month dividend yield of 3.15% and is very diversified with over 17,000 holdings. The top holdings of the fund are treasuries maturing in the 7 to 8 year range. Now let's see how a retiree would have fared over the last 25 distribution years if they had used this fund as their primary investment strategy. Our illustration begins with $1 million investment on January 1 of the year 2000. We're taking $40,000, 4% in the first year in January, and then growing that distribution by 3% for inflation every year thereafter. If this retiree was 65 when they retired, they'd now be 89 years old, and 25 distributions later, their portfolio would be $555,000. Interest rates were higher in the year 2000 with the 10-year Treasury over 5%. In the early years of this retirement illustration, the retiree was in a good place, and that's because the fund was earning more interest than the retiree was spending. Then interest rates began to trend down. In the short term, this helped the principal in the fund by pushing it up in value, but it also decreased the fund's income over time because the reinvestment of principal in the fund was at lower rates. You can see the impact of interest rates on the retiree's portfolio graph. Here we are in the beginning with $1 million, and the retiree is spending less than the portfolio is earning, and that allows the portfolio to grow. The other force here is the interest rates were going down, which also helped the value of the principal to go up. But then we reach a point where the fund value starts to drop. And this is for two reasons. One, it's the inflation on the retiree's spending. And two, it's the reinvestment in the portfolio where we're earning less income or interest on the bonds in the portfolio. Let's take a look at a data table so we can see these numbers in a little bit more detail. Here are the numbers up close. $1 million investment on January 1 of the year 2000, 4%, $40,000 comes out at the end of January in the first year, and then every January thereafter, we're taking out 3% more. We're growing this distribution for inflation until the final year of the illustration where we've taken out $81,312 in the year 2024. I want to draw your attention to this total reinvest column. This is the actual income that the fund is earning. And notice that in the early years of this illustration, the fund is earning more than the retiree is spending. The problem, however, is that over time, inflation ends up overtaking the interest column or the income that the fund is earning. And because interest rates went down, the fund is earning less. By 2023, the income of the fund is down to $19,000, only 28% of the original $67,000. Meanwhile, the distributions have essentially doubled. At this point, the distribution of $81,000 is approximately 15% of the $555,000 portfolio value. So let's sum it up. If you retired in the year 2000 with $1 million and you invested it in the Vanguard Total Bond Market Index Fund, today you'd be distributing $81,000 on $555,000 of portfolio value. You'd still have about half of what you started with. But here's the problem. How much longer are you going to live? I would estimate that this portfolio could last maybe another 7 or 8 years at the current distribution rate. And so there is a good chance if you live to say 97, 98 years old, you're probably going to run out of money. The primary problem with using an all bond investment strategy in retirement is that you don't have any inflation protection. In this illustration, the retiree's spending doubled over the last 25 distribution years. It went from $40,000 to over $80,000 $80,000. Meanwhile, the income in the portfolio came down. So it is prudent to have some amount of equities, stock market exposure in your portfolio to give you some inflation protection throughout your retirement. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.